Welcome to Financial Clarity for Doctors. My name is Corey Janoff, joined as always by Rochelle Vanderzanden.
Hello.
And today we're going to dive into the fun topic of investing in startup companies. So as doctors, you guys will frequently be approached by friends, family members, acquaintances to invest in their businesses or business ideas. Hey, I've got this cool business idea that I'm starting. We're looking for investors. Would you like to participate? And with a lot of them, you'll just say no, but some of them might intrigue you and interest you, or maybe just for one reason or another, you want to support your friend or family member, so you'll throw in a couple bucks. But we want to talk today and give you some primers on things to be aware of, things to consider, so that you can make smart decisions when it comes to those investments. Now, this is kind of outside of Rochelle and I's area of expertise. We don't really advise directly on this, and I don't even know if our licenses and insurance covers it. But we figured, given it is a somewhat frequent topic that comes up amongst our clients, let's dive into it on the podcast. So we brought in someone who does specialize in this arena. Our guest today is an attorney who specializes in startup companies and advising people on their investments in startups and the contract language and the terms of the agreement and negotiating on their behalf. And full disclosure, today's episode is just information only. This should not be considered investment or legal advice. So definitely consult with professionals to get specific guidance on your individual circumstances. But hopefully we equip you with some good information today to at least give you some food for thought. So our guest today is a good friend of mine. He's got a Bachelor of Science in Business Administration, an MBA, and a law degree from the greatest school in the land, the University of Southern California. And like I said, he's an attorney that specializes in startup companies. He's helped review contracts for some of my clients, and they've had nothing but good things to say about him. So Mr. Eric Perlmutter-Gumbiner, or EPG for short, welcome to the podcast.
Hey guys, thanks for having me on. And yeah,
Thanks for
Corey,
coming.
of course, as Corey mentioned, yeah, I pretty much do startup stuff all day. Work, mostly on the company side, but some, pretty big names like Barstool Sports is one that we've done a lot of work for over the last couple of years, but represent investors as well. So like I really get to see kind of the full picture of how this ecosystem works for everybody.
Yes, so we're excited to pick your brain a little bit here and extract as much free information as we can from you. But I guess, maybe just starting off, like I mentioned in the intro, doctors get pitched business ideas from, people all the time. If you were in their shoes, what are some things you want to see before you consider making an investment?
Yeah, I mean, I think there's three things that would really stand out to me as an investor. Like, I'd want to see a business plan from the person. What they're going to do, how they're going to do it, when they're going to do it. Definitive milestones of what they plan to accomplish when, and how they want to use my money, and how and when they're going to use it. Something that really clearly shows, like an 18-month plan, a 3-year plan, a 5-year plan, so I know what I'm getting into. I want to see some sort of experience. I know that's kind of like antithetical with a startup because somebody's like starting something new, but I want to see like that they've done something in that industry before. That there's a reason why they're capable of pulling this off. And then the last thing I want to see really is devotion. I want to know that they're all in and that this isn't like a side hustle for them. It's okay like if there's a few co-founders, if maybe like one of them hasn't quit their job or has got a family, needs income or something like that. But I really wouldn't feel comfortable investing in a startup where everybody else is still working some other full-time job and this is like a night and weekend project for them. Like startups are a super, super, super grind, and I'd want to know that these guys are all in if I'm going to give them money.
Makes sense. Hey, go ahead, Rochelle.
Yeah, no, I was just going to say that makes a lot of sense. I do feel like people get like a certain amount of information, and a lot of times it just doesn't seem like enough, personally. So I think just knowing the questions to ask is a really big help for clients. What are some of the differences when you're investing between, investing before a company is really operational and like after they're up and running and like kind of on their way a little bit? Where do you think is like the ideal stage to get into it?
I mean, the ideal stage is obviously right before an exit when you can get a quick multiple of a lot of money and then get out really quickly. But absent that, I mean, it really depends. It's just a different risk reward calculus. The earlier you get in, the more reward you're hoping for. You're hoping for, some big multiple, 5, 10, 15, 20 times your investment, because there's a ton of risk if you get in, especially if it's early before it's operational, that like it might not even launch. Once it becomes operational, your kind of reward expectations are tempered, and you're expecting a little bit less, but you're able to go off of things like you can look at the past financial performance. You can see, what their growth is like. You can see like, I mean, you would never expect them to make money, but you can see like, are their costs like out of control? Are they able to go like a year without raising money? Because usually startups should be raising money every like 12 to 18 months. So it really just depends. But I would say if you're investing pre-revenue, it's much, much more about like the people. And then if you're investing, once they're operational, people are still really important, but then you want to see results from those people.
Makes sense. What are some of the different ways that investment opportunities are structured?
Yeah, I mean, I think there's a few different ways that you might see something like this. Typically it would either be an equity investment or a convertible debt investment. If it's an equity investment, it's like buying stock, in a company that's on like the NASDAQ or whatever stock exchange, except the difference is that you can't sell it when you want to. You really have no protection or downside protection from buying equity. If the company goes under, if things don't go well, like you're screwed. Convertible debt, which is usually offered by earlier stage companies, offers a little bit more protection. That gives you the way that works is basically you're loaning the company now, and then the company gets to decide later on, or you get to decide later on, is the company going to pay me back, or are they going to convert it into equity? And that option is kind of a really powerful lever for the investor, because if they're unable to raise more money, which would convert the debt, then you can kind of hold that debt as a hammer over the company, and say, hey, like either pay me my money back, or I'm going to take over the company. I'm going to take control of the company. It gives you a lot of leverage at that point in time.
And is that convertible debt, like, is it the company's choice to convert, or can the investor decide they want to convert it or get their debt? Like, who has the power in that decision?
Almost all of the time, the company gets to choose to convert the debt if they can raise more equity. So you'll see something in there that says like, hey, we have $1 million of convertible debt from a bunch of different, smaller investors. But if we can find somebody to give us $3 million of equity, then your debt automatically becomes equity. And the benefit to you of doing convertible debt is that you're going to get more favorable terms when you convert into equity. You're going to get compensated for taking the risk of coming in before somebody else wrote a big check.
Absolutely.
If you wanted to, could you just say, I'd rather just get my original loan back? Like, is that an option, or kind of case by case more so?
I mean, you totally could, but the interest rate on these is usually not super high. I mean, it's like something like a 6 to 8% interest rate normally. And so, I mean, I'm not the financial advisor, but I think if that's the return you were targeting, these are super, super risky investments for that.
That makes sense. That kind of brings me to another question. Like, what is the general exit strategy with these products, and what's the timeline usually look like? Or,
I would,
at what point do you maybe know you lost your money?
yeah, it's usually about a 5 to 7 year investment, I would say. For almost all of these companies, the exit strategy is being acquired by somebody else. A really smart founder will kind of think about an exit strategy when they found the company and work backwards. Try to figure out, why whatever they're doing is likely to be acquired by Google or Apple, or if it's a medical device, by a larger medical device company or something like that. And I mean, there's really not a lot of chances for liquidity before then. So it is definitely something where if you put your money in, like, just assume that it's going to be tied up until you either make a return or like it's totally written off and lost. It's not like, 3 years from now, if suddenly you need cash, you're going to be able to get this back, or get some portion of it back. It's kind of generally gone at that point in time. And in terms of when your money's lost, I guess it's, you should be getting quarterly updates from the company, and when they start to get less and less rosy, that's a bad sign. But then also, if you kind of can get financials and you see that maybe, things aren't growing as much as they should, that's a really bad sign in terms of money being lost. Or if they stop raising new money, because a lot of times, that companies need this new, they don't generate enough cash by themselves to grow in their own money. They need outside capital to grow the company. So if you stop hearing about new financings, that's not a good sign.
So it's probably pretty rare, it sounds like, for like a company to quickly become profitable and start, paying out residual income to the investors. It's either like they get acquired or turn into a public company one day or something, or they just kind of fold. Is that what
Yeah,
I'm understanding?
yeah, very, very few of these companies turn into lifestyle businesses. Most people don't really found these kind of turn into the quote unquote lifestyle business where it pays out dividends
Yeah.
and just kind of hangs around forever. So yeah, it's either going to be a sale if you're super, super lucky, an IPO, or most likely nothing.
How does that work if you have stock in a company that's not public and then it goes public? Like what happens to your shares?
Your shares will be part of, I guess, there will be like a lockup that's on, it's the management shares, but then eventually like your shares will convert into common stock and there'll be shares that you can then sell on the public market.
A lot more liquidity.
Yes.
So when it comes getting back to the starting point of the investment, you said you could either get equity or convertible debt. Those are the two common ones. Like how feasible or common is it to be able to negotiate the terms of that investment?
If you're the lead investor, so if you're the one writing the biggest check, you get to set the terms. If you're somebody who's just getting approached to kind of get in around the sides of the investment as part of like a friends and family piece, then it's pretty tough to do any real negotiation on the terms. But when I'm working with people on that end, I try to negotiate around the margins. I try to, make sure that they have the right to put in more money so that if things take off, because, if it's a good investment, you might want to chase it with more money. I try to make sure that we get really full clarity of like the financial deal, because sometimes there can be a lot of stuff going on, especially if there's like a private equity fund involved and people can be getting certain deals. So I try to just ask a lot of questions to get really full disclosure. And then I try, to the extent possible to make sure that if there's a lead investor and we're on the side, that we're as aligned as possible with them, because it's going to be hard for somebody who's a friends and family person to get real decision-making authority, but I want to make sure that the person who has the right to make decisions on their behalf is aligned with their same goals and expectations.
Yeah,
Absolutely.
that'd be helpful. And then are there any, when looking at the terms of those contracts, are there any must-have components or any red flags that come up?
Yeah, so it depends if you're looking at convertible debt or equity. If you're looking at convertible debt, there's real two must-haves that I see. You want to make sure that there's both a discount and a cap. And what a discount is it means that when the convertible debt converts into equity, it's the percentage discount you're getting on the purchase price that the new money coming in is paying. So basically, it is the compensation for the risk that you're taking by investing way earlier than somebody else. And then the flip side of that is there's also something called a cap. And that works in tandem with the discount. And it says, hey, if the discount doesn't provide me with enough upside, then instead, I'm going to convert it into certain value. And so that's basically like setting a valuation for a convertible note. And you really want to have both of those, because, if you only have a discount, you just really can only make kind of like an initial kind of 20% return based on what the new money's coming in at. And if you only have a cap, then if they and especially if the cap is set too high and the company raises money at a lower valuation than you were expecting, then you don't get any benefit at all for coming in early.
And is that is that like a common discount on convertible debt, 20%, or is it kind of all over the place?
Yeah, I would say 20% is the common discount, and probably 90% of these things. You'll see sometimes 15 or 25%, but it's almost always 20%.
And then for a cap, how does that? Is it like a ratio of the initial value that you invested at, or how does that one? What can you negotiate there?
The cap is kind of like the fictional value of the company at the time that you
Okay.
invest. And like the dirty little secret and all these things is that like the valuation for like, very early stage companies, it's just totally made up. And it's just whatever the investors and the company like are willing to agree on. There's no rhyme or reason for any of it. But, for somebody to say an idea is worth, $6 million by itself.
All right, so you're investing in a $6 million idea because we all agree it's probably worth 6 million. So then if you're getting, if you're putting in 1% of that, you'd get 60,000 as your cap, or maybe you negotiate a little bit higher because you're hoping for some growth. Is that
If you were putting in 60,000 and you wanted 1%, then yeah, you'd set the cap at 6 million.
okay? Got it. All right, good to know.
Mm-hmm. And then yeah, a couple other things you'd look for is just information rights. If you're I'm assuming like it's kind of like a friends and family, and you're like one of like the secondary investors. So information rights, making sure you're getting financial statements, making sure you're getting board reports, like updates about material events, and then preemptive rights, like the right to put in more money if things take off. Because if it does become a really really good idea, you're probably going to want to be able to invest more in it.
And then are there any red flags like that you just say, hey, don't even consider this, or you got to get this taken out of the terms?
Yeah, I mean the things that I guess would view as red flags are like any sort of like impediment to you getting your money back, or really like if you start to find out about like side deals. If you start to find out that there's other people who are going to like be providing services for the company, and maybe they're going to help with like finding a location, and they're going to charge like they own a piece of the company, but they're also going to be like charging rent for this like related party lease that they're going to be providing, like all sorts of stuff like that, where it seems like kind of people are milking money out of the company before it goes to the investors.
Hmm. Do you feel like there's a number of investors that's kind of ideal for a project, or is there like a point where it gets to be too many or just not enough people are involved?
Yeah, I think what I like to see is kind of one or two large investors that are writing checks for 60 to 80% of the round. Um,
Hmm.
and then from there, you can have a bunch of small investors that fill it out. But like, let's say if you're raising like, $1 million and you've got 20 people putting in, $50,000, like that's not a great look. Like you want to see that like somebody believes in enough that they're, sophisticated and willing to write a big check.
Somebody
And
with
for
deep pockets.
Yeah.
and then does
Yeah.
it matter like who or those deep pockets are? Or could it be do you want it to see like a private equity fund or like another company, or if it's just some rich person who wants to invest a bunch of money? Like, does it matter what their background or pedigree is?
Yeah, I mean, I like to see it, be a venture capital fund or private equity fund, or somebody that knows what they're doing. There are occasionally like some startups that'll target like a rich person just because they want money and they don't want to give up much control. But, as like a secondary investor, you always want to see somebody else writing a big check that clearly knows what they're doing, because it's a good sign that you're also making a good decision. And then like that person's also going to add a ton of value to the company, from their knowledge and experience, and you're going to get to piggyback off of that.
When the primary investor is someone that's involved in the project, does that a red flag? Like, oh, maybe they have too much committed to this.
Like, are you talking about like somebody who's like self-funding their own
Yeah,
project?
exactly. Yes, yes.
No, I like that. I mean,
Okay.
it's good to see that somebody's like basically put their money where their mouth is, and like if somebody's they believe in it, they've liquidated like their portfolio to start this thing up, like that goes back to what we talked about in the beginning about making sure that people are committed and all in, as opposed to like, oh, I'm going to do this after my full-time job for a couple hours a few nights a week.
Mhm.
So then do you think like, is it more important to have good people running the business or the idea for the business, or does it kind of go hand in hand, or is there one that you put more weight in than the other?
I would say good people are by far more important. No matter how good the idea is, if you don't have somebody who's really smart, really organized, a good leader, you're not going to end up with a successful product. Like it is so hard to start a company. There's so much involved, that like talent is always, it's not always going to win out, but it's the most important thing.
You
There you
talked
go.
a little bit about quarterly updates that are generally expected. Is that like the only communication that investors generally receive, or are there other kinds of information that people should expect to be getting?
Yeah. I mean, if you're kind of a secondary investor, yeah, you should be getting some kind of like quarterly email. Might be a page or 2 pages or whatever, just letting you know what's going on. And then you should ask for and hope to get like annual financial statements. But beyond that, you're probably not going to get much else formally. Informally, of course, you can always call or text the person, reach out, see how things are going. But keep in mind that like you shouldn't harass them. Don't ask
Mhm.
every week, what's going on. This isn't like Apple with a stock price listed on the Nasdaq that you can check or whatever.
Makes sense.
So we're all well aware that most startups don't pan out. So yeah, I guess maybe what should the expectations be going in? And aside from what we've already covered, is there any strategies for investing so that you're not just throwing money away?
Yeah. I mean, I think the expectation always going in should be that like this is a lotto ticket, and that like if it hits, that's awesome. If it doesn't, like it was just a scratcher you could toss off into the trash anyway. But in terms of strategies, I think there's really two things to think about. The first is to invest in what you know, because that makes it a lot easier for you to evaluate, how good or bad the idea is, what kind of potential it has. I know a lot of like there's a thing called Y Combinator, which is a big accelerator in the Bay Area, and like a lot of like medical devices companies come out of there, startups come out of there. So like maybe that's a good thing for people who are listening to this podcast, who are doctors, who can evaluate, how good or bad or useful these devices are, what the market is for something like that. And then you kind of get yourself an advantage on that, relative to like if you're investing in some random consumer products company that you don't know anything about. It becomes much more of just like throwing darts at a dartboard. So yeah, definitely put your kind of specialized knowledge to use. And then the other thing is to just diversify. If you've got $100,000 you want to invest in startups and somebody comes to you, don't put the whole $100,000 in the first one. Put a little bit in that one and wait, and see what else comes down the line. Because the odds are that like none of these or these all are not all going to hit really really big, but one or maybe two or whatever, depending on how big your portfolio, are going to hit really big, and they're going to get you a home run return that makes up for the losses on the other.
And is that one or two out of 10, 50, 100? Like what
That's
are the
what I was going to
ratios
ask,
here?
Corey.
Well, yeah, I mean, it depends on how good the opportunities getting presented to you are, but yeah, I mean, it's one or a true home run is like 1 out of 50 or something like that.
Mhm.
Okay.
Yeah.
So then for like if you have your 100,000 that you're gonna do this, like do you just put 2,000 in each, or is there a minimum investment that a lot of these places want?
Yeah, I mean, it depends on how early you're coming into the company. Usually, the earlier you come in, the smaller check size you can write. Um, but yeah, I mean, I would do something like, 25,000 in each one. Enough where like if you get a 10 or 15x return, like it's really going to do something for you. But not so big that like if you lost it entirely, you're in a bad spot. If you
I
just
do
put in
think that's,
sorry,
no, go
continue.
ahead.
I was to say, if you just put in $2,000 and you make a 10 times return on that, I mean, I guess you can buy a Civic, but it's not going to do a ton for you.
Yeah. I was just going to say that, I mean, it's a good point to kind of harp on because it's not a small investment. So for most people, like you kind of have to have everything else on track before we're kind of thinking about doing this. Like it's important to make sure that we're doing retirement planning and all of that kind of stuff before you're doing this because it's extra. It's not necessarily going to pay off. We don't know exactly what it's going to look like long term. But it can be lucrative.
Yeah, I would think of these as more like a fun hobby thing rather than like
Mhm.
an integral part of a financial plan. Like if it's something you enjoy, you're interested in, you want to learn about these companies, you want to get involved, and you're willing to pay some money to do it. But don't go into it thinking like, oh, if I put in $100,000 in this, that's for sure going to be $2 million, 5 years from now that I can, put towards whatever, a house, our second house.
Mhm.
Yeah, let's make sure the plan still works just fine without assuming this money goes down the drain and you never see a penny back.
Mhm.
I guess anything else you can think of that doctors should be aware of before considering these types of investments?
Yeah, I think one thing that I've seen kind of come up a bunch of times is, people getting a first chance at liquidity from an investment, and not necessarily selling. Like, like someone comes and says, I want to buy like, 2/3 of this company. You get the opportunity to either sell or like hold on and roll forward. Always, always, always sell enough to at least get your initial investment back. However good you think the company is doing, however lucrative you think that second chance is going to be, it very, very rarely comes. That first bite at the apple is almost always the best and only bite. So just take some of it when you can.
That's interesting. Yeah, that's not something I knew or would have expected. But
It makes sense. Just you're going in with an extremely risky investment that you're expecting to not see any money back from. So if they're willing to give you something back, let's take it and be happy. And then sure, we could leave a little bit more in there for hopes that we see more in the future. But yeah, take your winnings off the table if you can.
Yeah, I've seen a lot of people, this has come up several times where there's been, a first bite and people hold off and they don't sell and wait for a second bite, and they get everything gets wiped out and there is no second bite. So definitely take some profits off the table when you can and enjoy them a little bit.
Are there like any common themes or causes for that second bite not happening, or is it just an array of the business world changing environments, risks, sentiment, people? Or
yeah, I mean, I think the biggest thing is that like these investments, these companies are still really, really risky. And so, just because somebody's coming in and offering to buy a piece of that company at some point, a big piece of the company at that point in time, doesn't make the company any less risky going forward. The big expansion plans that they could have, lined up, as to why somebody wants to come in, could totally fail. You're still not dealing with like a Ford or GM or something like that, where like no matter what, they're going to sell 20 million cars a year. Like, these are risky companies. And when people come in and they want to, do this first bite at the apple, like they're also being compensated for their risk. So they're going to make sure they get a lot of downside protection. And the way that usually works is that the last money in is the most protected. And so you're going to lose some of the protections you had.
got it.
good to know.
This has been really enlightening. I think I know even less about this than Corey, so thank you very much.
Yeah, of course. Happy to hop on and talk to you guys. And yeah, hopefully your listeners will get something of value out of this.
Yeah, thanks a bunch, Eric.
No problem. Talk to you guys later.
We would love to hear your feedback and suggestions for future topics you'd like us to cover. You can get in touch with the show by emailing podcast@thefinitygroup.com or by following Finity Group on Facebook, Twitter, Instagram, LinkedIn, and YouTube at Finity Group LLC.
You can follow me on Twitter at Corey Janoff CFP, Instagram at Corey Janoff, or on LinkedIn under my name, Corey Janoff.
You can follow me on Twitter at Rochelle Finance, or on Instagram, Vanderzanden Rochelle, or on LinkedIn under my name, Rochelle Vanderzanden.
Check out all of the podcast episodes on the finitygroup.com/podcast, on our Finity Group YouTube channel, or your favorite podcast app. And don't forget to check out our financial clarity blog at thefinitygroup.com/blog.
Thanks for listening to this episode of Financial Clarity for Doctors by Finity Group LLC.